Welcome to Central Bank Central. I'm Kathleen Hayes. 2026 is underway, and the Federal Reserve is no less busy than ever. Next week, of course, the first policy meeting of the year. Meanwhile, this week, the Supreme Court hearing arguments about whether or not the president can fire a Federal Reserve Board governor. And oh, by the way, we're still everyone pretty much waiting on the edge of their seats to find out who President Trump is going to nominate to replace Jay Powell, the current Fed chair. So, great time to welcome back to Central Bank Central, Bill Dudley. William C. Dudley, in fact, is former president of the Federal Reserve Bank of New York. He is currently the chair of the Bretton Woods Committee and a member of the Group of 30, and much, much more to keep him very busy. So, Bill, thanks for taking the time today.
Pleasure to be here.
Well, let's start with the Supreme Court. Everyone's interpreting the questions that were asked. Indicating that they're not really in favor of moving to actually allow the president to fire Lisa Cook. Uh, what did you hear in that? What do you see in that? And do you think this is going to settle the matter?
I think the Supreme Court, by their questions, basically and observations, basically was saying two things. Number one, the Federal Reserve is special. It's not like in other independent agencies. They talked about the importance of Fed independence, and obviously letting Lisa Cook's firing stand would be a big blow to that independence. And two, I think there's also a notion of, sort of due process, like, is it okay to give notice by social media, which is how Lisa Cook was informed by President Trump, and what kind of due process is there in terms of establishing the facts before you actually are allowed to dismiss someone. So I think at the end of the day, I think people have reached the right conclusion, which is Lisa Cook's going nowhere for certainly quite a while. And the reading of what actually happened in terms of the facts of the case, in terms of what's been reported in the press, suggests that you know it's not even obvious that Lisa Cook did anything necessarily wrong. So I think this my own view, this is not going anywhere from the President Trump's perspective.
How much does that reassure the Fed?
It's reassuring in one way, in the sense that you've sort of put your finger into that hole in the dike. But it's not reassuring in the sense that, just because this threat to central bank independence has been blocked doesn't mean there can't be other threats. And yeah, we saw that with the Justice Department issuing a subpoena to Chair Powell about the cost of the renovations to the Federal Reserve headquarters. Um, because that's basically they're basically creating a for cause, notion for dismissal of Chair Powell potentially. Obviously Chair Powell pushed back very hard with that very short video, basically saying this was a pretext to undermine and put pressure on the Fed, and basically drew a very firm line in the sand, which I thought was extremely effective but both because it was very clear, but also because of it stood in marked contrast to how, uh, you know, moderate his responses to the Trump criticisms have been in the past. He's always sort of held his fire. He hasn't really risen to the bait as President Trump has criticized him, a lot over the last few years. And this was a red line was clearly crossed. And I think you could see the fact that the Powell move was effective because there was a little outpouring of support for him by other former Fed officials, central bankers around the world, that it was time to sort of say, no, we shouldn't, this shouldn't happen.
And of course, one of those key accusations that was made over the past, God, this is going on for months now, right? About the renovations was that when Powell testified last year to a biannual monetary policy report to Congress, as I recall, just at the very last minute of this whole thing, Tim Scott who is, of course, the head of the Senate Banking Committee, Republican, just ask him pretty simply a couple of questions. And in that, how Powell responded is viewed as he lied. He lied to Congress. It would seem to me that would be a very simple thing to settle quickly, talk about it. Here's what really happened. And we that remains to be seen. But I think more importantly, I think there are some very important questions about central bank independence. What is it? How do you define it? Where does it begin? Where does it end? And I'm sure you recall well, in just the past several months, when Treasury Secretary Bissent did an article entitled Gain of Function Monetary Policy. And he takes the position the Fed has not stayed in its lane and has tried to broaden its influence. And he says this is a major reason the Fed is under pressure, that it has not stayed neutral in its lane. What do you make of that? Not just that argument, but what do you see for the Fed? What about the lane? And what about there has to be maybe some more definition or more clarity on what that is.
Look, I think that the Trump administration is trying to come up with arguments to, attack the Fed, and the staying in the lane argument, has a little bit of resonance because in two ways. Number one, the Fed did take on the issue of climate change and said basically this is something that's potentially a risk to financial stability. If lenders are, lending against condos on the Florida beaches and the weather threats increase, you could have a loss of value of those properties. For example, if they became uninsurable, all the people that made mortgages against them would be in a great deal of difficulty. So I personally think that the Fed's focus on climate was actually completely reasonable from a financial stability perspective. But that's an example of where people argue that the Fed has moved away from going straight down the middle of the highway. The other area where the Fed was, I think, criticized a bit in terms of deviating was how they talked about their employment and inflation goals in the 2020 monetary policy framework, where they talked about, they changed their goals for unemployment. Basically, we want to, make employment a broad-based and inclusive goal. So they weren't just talking about the level of employment; they're talking about who is employed. And they're sort of basically a shout out that we cared about less advantaged groups in terms of what their employment prospects are. And I think that was unfortunate in two ways. Number one, that was a sort of expansion of the Fed's monetary policy framework, and two is unfortunate because the Fed's monetary policy can't do anything about that. The Fed does not have the tools through monetary policy to disproportionately help one group of the population versus another in terms of their employment prospects. So, one, I think it was a bridge too far in terms of what you commit to, and two, you don't want to commit to things that you don't actually have the tools to accomplish. But this is all small potatoes in my mind. This is just an excuse to find reasons to attack the Fed. Um, Look, my view is that central bank independence is hugely important because central bank independence leads to better economic outcomes. A central bank that's at the whim of political pressure in the election cycle is going to keep monetary policy too easy in the run-up to an election, and then they're going to have inflation as a consequence, and then they're going to have to tighten monetary policy after the election. So it's going to be sort of a stop-start kind of monetary policy. And that's going to lead to more volatility in the economy and poor economic performance. There's been a lot of economic research done on this around the world
Right.
that central bank independence leads to better economic outcomes. Now, the question is, how far does central bank independence go?
Yes.
It doesn't mean that the Fed gets to set its objectives. Congress sets the objectives for the Fed in terms of what goals you're supposed to accomplish through monetary policy. And as you know, in the Humphrey-Hawkins Act back in the 1970s, the Congress basically said, we want you to obtain maximum sustainable employment in the context of price stability. And so the Fed basically it defined price stability as 2% inflation. And so the Fed basically trying to keep
Okay.
the unemployment rate at full employment and trying to hit 2% inflation
Uh-huh.
because that's the mandate set for them by Congress. But the Fed doesn't set the mandate. The second thing I would say about independence that's really important is how do you maintain your independence? Well, to maintain your independence, you have to be accountable. You have to be willing to listen to what people are saying, and you have to be willing to justify your actions. And so, you know, independence doesn't mean that you just get to do whatever you want and you don't have to tell anybody, explain what you're doing. And I think
Yeah.
the Fed probably could do a little bit better job on accountability than they've done up to now. And I think this is about communication. I think this is about having a better developed framework for QE and QT. Um, you know,
Okay.
I think they could do better. But so the best way to defend your independence is to do your job well, essentially.
Okay, I agree with that. And I would like to add to the whole green question that subsequently to agreeing to some things, the Fed has backed off, right? I mean, it seems like, and that I would like to see make this a bit bipartisan. If the Democrats were the ones who were having a hard time getting some things through Congress that they wanted, and they were able to pressure the Fed, many have argued, to help them by jumping on board with this. And I would agree. If you think this is going to help climate change, it wasn't a bad thing to do, but I do think that this is obviously, I think as far as maybe I'm trying to say is this happens to central banks. And yes, you have to push back, but I'm very glad that you just raised the questions of accountability, things you could do better. You talked about the 2020 framework review. Well, the Fed basically went back to the 2012 framework, but did they really take account? Were they really accountable? Did they really look at it closely? Under Powell, did they really say, yes, here's what we did wrong, here's what we have to do better, let's do something to really change this? Or did they just say, okay, we'll have to go to the twice a year, biannual testimony, and we'll get a lot of questions, but it's not really the same, it seems to me, as taking this and really dealing with it.
I think that Powell did at one point admit that the especially the commitment to keep rates at zero until the unemployment rate was at full employment and you're at 2% inflation and you thought inflation was going to be above 2% in the future. I think he admitted how they operationalized the 2020 framework was a mistake. But to your point, I think the Fed could be more forward leaning in terms of saying we didn't do this as well as we wanted to do, and here's how we're going to here's what we've concluded, and here's how we're going to behave differently in the future. That's a perfectly reasonable thing to say. Basically saying that, well, inflation was a global phenomenon, and U.S. was not, very different in terms of timing of liftoff. Those are all true facts. But at the same time, I was writing at the time that I thought that the Fed's how the operation of the framework was crazy because you're basically keeping monetary policy at maximum stimulus even as the economy was already at full employment. That just didn't make sense. And what's interesting that we've just released the Fed has just released the transcripts to 2020, and there's a
Yes.
whole meeting about this discussion of Powell pushing for how to operationalize the 2020 framework in terms of how the Fed would actually conduct monetary policy. And what's interesting about it was there's quite a bit of pushback.
Oh,
There's quite a bit
yeah.
of disagreement by other members on the committee. Like, do we really want to do this? Do we really want to do this so quickly? Can we talk about it a little bit further? So I think it's pretty clear with the benefit of hindsight, this could have used a little bit more deliberation and discussion.
Well, yeah, and I think that's one of the first things that jumps out to everybody. Of course, these minutes come when they come out, 5 years later, they're long. You've probably been spending hours and days already, but it is pretty clear that some people who were recently at the Fed, still at the Fed, pushed back pretty hard and ultimately decided to back the Fed chair. How do you interpret that? Was that something about what do you think? Or is
Well,
that
I think
because
there's a,
that's going to be that's going to go FOMC by FOMC, right? You're going to always have a different group of people, but
I think there's a tension there. So they published this 2020 framework, which was quite different in terms of the monetary policy reaction function. We're going to wait a lot longer, but they hadn't yet turned that framework into how that actually is going to translate to how we're actually going to conduct policy. And so I think Powell felt like the framework itself is not enough. The statement is not enough. We have to actually sort of tell people how that actually is going to be turned into practice. And so I think he felt pressure to do that. And I think, with the benefit of hindsight, I think that they didn't realize that the economy was going to come bouncing back quite as fast. So if you look at the summary of economic projections at the time, they thought interest rates were going to be really low for a very, very long time, years into the future. And so it was a combination of feeling this pressure to come up with something more tangible in terms of how this would translate to monetary policy and a forecast that we're not going to be lifting off for a very, very long time that I think basically put them in that situation.
Mhm.
And I think Paul would admit, it'll be interesting if he's asked at the press conference about this. I think he would admit that that was a mistake in terms of how they operationalized the framework.
So let's move on to where policy is now, um, in terms of Fed cut rates 3 times the last few months of the year. right? And now they seem to have pretty much signaled, we're ready maybe to wait. So when you look at how they've been operating, they were ready to cut rates quickly when they thought there was maybe some risk to the labor market. They were been willing to tolerate well above target inflation, and I'm seeing more and more, go to Project Signa, go all kind of places where people are saying inflation is in danger of going even higher this year. They seem to keep telling us it's going to, I mean, they seem to be in this certain kind of space. So how would you characterize where the Fed is now? What is sort of this mini policy framework with what they're doing and what they're going to do next?
So I think where they are is they basically think that the upside risks to inflation have diminished. And the reason why for that is that tariffs seem to be less high than what people thought. Number two, shelter costs are turning over. So basically housing is softer. And so therefore you're seeing less pressure from the housing sector. And I think the third thing is that wage inflation has come down a bit. So the last employment cost index was quite interesting, 3.5% rise in total compensation costs for private workers over the last year. That's very consistent with a 2% inflation outcome. So I think they're more comfortable about the inflation outlook than they were. So I think they're more comfortable that inflation is going to come down on its own
Okay.
over the next year. And second, I think they're less worried about the downside risk to the labor market because as they're I mean, the economy looks like it's been stronger than expected. I was quite taken by the personal consumption expenditure increases that we reported this week, up 0.3% in real personal consumption expenditures for both October and November. That's a pretty strong showing in the midst of a government shutdown where a couple million workers are being
Yeah.
disturbed by not getting a paycheck. So I sort of felt like the economy looks like it's holding up pretty well. And then on top of that, when you look to the 2026 outlook, the economy is getting getting some tailwinds from a couple of sources. Number one, the fiscal policy is turning more stimulative. Some of the tax cuts that were enacted in 25 actually are going to have their impact in 26 because the withholding tax rates weren't changed. So people who get tax cuts for overtime, tax cuts for Social Security, they're going to get the tax cuts when they file their tax return this spring. The depreciate 100% expensing for investment, that's going to take place this year. So fiscal policy going from restraint in 2025 because of the tariffs to stimulus in 2026. And then financial conditions are very accommodating. The Fed's cut rates 3 times. So the whole stance of monetary policy, we can argue about whether are we slightly restrictive, are we neutral, are we slightly easy, but we're clearly not, very restrictive at this point.
Well,
So
how,
monetary policy is not really holding us back.
I have to push back against that. Is it restrictive? How could you say monetary policy
I
is
don't think
restrictive?
look, I don't think it's restrictive at all. So
Okay, well, let's think.
uh,
What do you think? Yeah.
yeah, I'm talking about where the board is. So,
Okay. Okay.
I think I think the FOMC as a group thinks that monetary policy is still slightly restrictive. I think there are members of the FOMC who are sort of in my camp, looking at financial conditions, the value of the stock market, the level of the dollar, the level of long-term rates. Financial conditions right now are very stimulative. And you can actually see that in the Fed's own financial conditions model that's available on their website. Once a month, they publish they update their model. And the last time I looked, the impulse to GDP growth over the next year from stimulative financial conditions was over 1% positive impulse. So yeah, I think, my view of, looking at, figuring out what R star is, you sort of have to look out the window and see how the economy is performing. And if the economy is performing better than you thought, then you need to revise up your estimate of R star. So I'm
Yeah.
completely in your camp that the monetary policy is not holding the economy back, but there are people on the FOMC who still think policy is modestly restrictive.
Hmm. Well, even somebody who's been pretty I shouldn't say even, but including Austin Goolsbee, president of the Chicago Fed, labor market economist, he still thinks they may need more rate cuts. But including Austin, he has said more than once recently, let's pause. And I think that's
Yeah.
he's one of those. There's enough voices like that that they figured this week the Fed will pause. And I'd like to remind you, you probably follow your alma mater, Goldman Sachs, pretty closely. That's where we first started talking to each other, right? When you were chief U.S. economist and sitting with all the bond traders on that desk, and back in the mid '80s, they're looking for at least 2.75% GDP growth this year. And I think that to me is, do you think maybe we'll get, what do you think the message will be from the meeting? Because they're not going to, we'd all be shocked if they actually did something. But the messaging is going to be so important, not only in the statement, also from Chair Powell. What are you expecting?
I'm expecting to say something to the effect that the risks are, much more in balance. Before the reason why we're cutting it was policy was restrictive, and the downside risks to the labor market were more significant than the upside risk to inflation. Now I think they're going to basically say the risks are much more closely balanced, and monetary policy is not as restrictive. So the motivation, the rationale for cutting rates is just not there now. I think that the Fed's not going to be on hold for many months. I mean, I think the Fed's on hold until the economic news breaks and basically says, gee, the inflation is more persistent than we thought. We got to do more to get inflation down, or the economy is weaker than we thought, and the downside risks to the labor market are starting to increase again. And I think it's going to take many months to get into that situation. Now, obviously, people are saying, oh, gee, the new chair is going to come in and the new chair is going to cut rates because that's what President Trump wants. The new President Trump has made the new chair's job a lot more difficult because by impugning by basically eroding away the independence of the Fed at the margin, Fed officials at the margin, potentially the chairman accepted, are going to be more reluctant to cut rates if it's a close call. Because if they cut rates, if they cut rates if it's a close call, people are going to be wondering, are they cutting rates because the economy needs it, or are they cutting rates because they're feeling the pressure of the Fed? And that means you're putting some risk to the credibility of the central bank in terms of how independent it is. So the other issue I think for the new incoming Fed chair is how do you manage between the president on one hand expecting to cut rates dramatically and an FOMC that wants to keep rates on hold? I don't know what you do. I mean, if you go to the meeting and if you advocate for rate cuts, do you vote for a rate cut even though the committee is going to vote against you? I mean, we don't have any experience in the US where the chair gets upvoted by the FOMC membership. So that would be quite shocking. But on the other hand, if the incoming president doesn't advocate for cutting rates at the first meeting that they chair, what's the president's reaction going to be to the person that they just named? So it's a really, I mean, I'm hoping that the chair does what's appropriate for the economy and for monetary policy and does what they think is appropriate. And I'm guessing what's going to be appropriate is to vote for no change in rates. But boy, the president has made the new incoming chairs much more difficult.
Well, a couple of things. First of all, it's ironic because the Fed has been doing what Powell, I mean, excuse me, what Trump has wanted lately, right? Cutting rates. You've got, you've got inflation well above target. You've got, a labor market that is weaker, but not necessarily because of demand, right? But because there's fewer need for workers. There's less high, all those things that complicate. And that the Fed has done three rate cuts in a row. The Fed was cutting it at the beginning of last year. And then, that was a bit of a up. We saw inflation go up again. But it's so funny because I think it makes it harder to even understand kind of it's not so black and
Why,
white
why, why,
sometimes.
why is Trump so mad at the Fed when they cut rates three times? I mean, a lot of people, I would think, think this is all about the rate cut that they did before the election, right? And the idea that that was sort of politically motivated to help the Democrats. I just don't think that's how the Fed operates. I mean, if you go look at the transcripts that are available for many, many years, you'll see no discussion whatsoever in the transcripts about the election cycle, about politics, about which political party a person favors. It's just not there. The Fed acts very apolitically, as it should, because as our earlier conversation, that's the best way for the Fed to be able to be independent. You have to
Right.
trust the Fed that they're going to call it, their umpire. They're calling the balls and strikes as they see it. They're not trying to skew to one side or the other based on who's in office.
Would you care to comment on who you would like to see as the next Fed chair?
No, because it doesn't really matter what I think. I think most people think it's going to be either, I think Kevin Warsh is now the odds-on favorite according to Polymarket, and Rick Reeder has come up quite a bit over the last a few days. But the president is quite mercurial, as we know, and what he thinks one day might be something different that he thinks the next day. And so, only thing I can say with certainty is I think we'll know relatively soon.
Okay. And I want to come back to a couple other questions here. Inflation, for example, you seem pretty sure inflation is going to come back down. What if is it do demographics help you drive that view? A glut of manufacturing goods. People are talking a lot about cheap manufacturing goods from China now, AI, productivity. Uh, because again, I think there's some growth doubts growing about if it is going to come down, and the Fed already, some would say, has lost some of that inflation fighting credibility. But what makes are you pretty sure inflation is going to come down? Is that what you would be counting on if it was up to you to be guiding policy?
I think it's going to come down a bit because I think shelter costs are rolling over. That housing is a big important component of the inflation statistics, and it's very slow moving. And the fact is, we're not creating a lot of jobs, and so we're not creating a lot of households, so we're not creating a lot of demand for housing. So I really do think that that continues. AI probably is boosting productivity a bit. It's probably smaller than what people think, but still positive for the inflation outlook. And as I said earlier, the wage inflation is come down. I mean, end of the day, we were running wage inflation in the employment cost index in 4%. Now we're down at 3.5. 3.5% seems to me much more consistent with 2% inflation. So I, you know, you know, I don't think it's going to be a fast process. I mean, I think the first part of the year is going to be sort of difficult because the last few years we've had sort of what economists call residual seasonality, where inflation tends to be high in January and February, just because that's where people tend to move, adjust their prices. And, obviously if that happens every year, the seasonal adjustment factor should account for that, but the seasonal adjustment somehow hasn't kept up. So I wouldn't be surprised if, when we get the January and February inflation news, it'll be a little bit sticky, but after that, then I expect us to resume a downward path.
Does the 2% target mean less now? If you can go for so long with a 2% target, five above it for 5 years, just about now, people kind of implicit go, oh, it's fine. We know it's going to come down. And is that different from how things used to be? I mean, when you were the president of the New York Fed and the vice chair at the FOMC and all that, would you have tolerated this? Or did you care back? Did we care less about because we didn't really have a target, right? At first, back when we first started, right? But now what do you make of that? Because I think a lot of people, I'm wondering, gee, if you can never hit your target, is it a target?
Well, I think the Fed understands that if they don't get to 2%, then inflation expectations can't stay well anchored. So, yeah, to your point, they don't see it showing up. They're not showing a real urgency about inflation tracking 2.8% rather than 2%. But at the same time, I think they really do realize that they do need to get to 2% because if they don't get to 2%, inflation expectations will drift up. And if inflation expectations drift up, your inflation target will no longer be 2%. You'll have to put the economy through the ringer to get back down to 2%. So I think they're still committed to that goal. But obviously, if you're below 3, the intensity at which you're going to try to get
But
inflation
that's
down.
not the core. The core is up
No,
at 3. You got to take out the food and energy bill, right?
so I think when inflation's at running around 3, I think you are a lot more patient than if you're at 4 or 5.
Sure.
But I still think your goal is the same, that you want to get back to 2 in the medium term. But to your point, I mean, the risk is that every year we stay above 2, the risk is that inflation expectations finally start to become unanchored. I think the most remarkable thing about the last 5 years is the fact is the Fed has persistently missed their inflation objective on the upside, and yet long-term inflation expectations have stayed well anchored. That's
Well, not
quite
not if you look
surprising.
at not if you look at the University of Michigan's.
That's the one exception.
Well, yeah, but it's a pretty strong one, and that's a very long survey,
Yeah,
right? About 50 years there. And
yeah.
several weeks ago, Loretta Mester, former Cleveland Fed president, pointed out to me that they have the Cleveland Fed, which was started in this survey under her, I think, the business expectations suddenly went from what do you expect on inflation? 2%, suddenly it jumped to 2.5%. So I think people would say if you look at some surveys, there is more of a kind of chipping away at that. But strictly a very specific question on the balance sheet. You are you think that it needs I want to give you first. You give your statement, your view on the balance sheet and what the Fed needs to do with it and why it's so important. I mean, it's very technical for people who don't really follow the Fed, haven't been in bond markets, et cetera. But what's the issue there, and what is your position?
So there's a debate about should the Fed be running such a large balance sheet. So the Fed's balance sheet, prior to the great financial crisis was about 800 billion, and now we're around 7 trillion. And so people are saying, boy, the Fed has this big footprint. That footprint's really bad. We need to shrink the Fed's footprint. And yeah, it's I think there's two problems with that argument. Number one, you have to explain to me why the big footprint is bad. I mean, basically, what we're doing now is we're running a different monetary policy regime where we pay interest on reserves, and there's lots of excess reserves in the system, and the banks use those excess reserves to satisfy their liquidity needs. So in the old regime, banks held treasury bills to satisfy their liquidity needs. Now they hold reserves to satisfy the liquidity needs. Could we shrink the balance sheet and go back to that old world where we force banks to hold treasury bills rather than reserves? Absolutely. But my view is why would we? What's the benefit that we're achieving? So I think that there's a lack of, I think, articulation about why a smaller balance sheet is necessarily better. And I think the second thing where there's a lack of articulation is what would actually be required to shrink the balance sheet. You'd be dramatically changing how you conduct monetary policy. You essentially have to push money market rates above the interest on reserves to get banks to not want to hold reserves, but to want to hold other money market instruments. So that means that the whole relative level of money market rates versus the interest on reserves has to change. And that's a pretty dramatic change in terms of how you conduct monetary policy. So my view is it's not worth making the change. The current regime works actually quite well. And I think that the person who wants to go to a much smaller balance sheet needs to articulate the benefits of doing so.
Well, if you could get a smaller balance sheet and under the price is a little more volatility, back when I first met you, that's how it was done, right? You had volatility in the Fed funds rate, and it was managed. It was managed daily, and it didn't seem to ever be a problem to
And,
anybody.
and
So I guess that would be the other side. Why not do
But
that?
but 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 why is that volatility good? I mean, what is that volatility getting you? I mean, the old regime was extremely complex, as you remember. The Treasury cash balance at the Fed was de minimis. The Treasury held all its money in with banks through the tax and Treasury tax loan accounts. Uh, the Fed had a 2 week reserve maintenance period with carryover provisions. The Fed every day had to forecast all the factors that were adding reserves, draining reserves, and then have to intervene in the market to make the reserves just the right amount to achieve their federal funds rate. Why do we need such a complicated Rube Goldberg system when we have the current system where we can just set the interest rate on reserves and we're done? The second advantage of the current regime over the old regime is the old regime, you could never offer ex ante open-ended balance sheet access during times of stress. So, because you're always worried that if you had an open-ended facility, people would borrow so much from the Fed that would add so much reserves that you wouldn't be able to drain reserves and you'd lose control of the federal funds rate. The federal funds rate would collapse to zero. Now, because you have the interest on reserves, you can actually have ex ante facilities that are open ended in size. And that's really useful in a financial crisis because if I have a facility
See.
that only has this much on offer, my incentives are to go get it before it runs out. But if I have a facility that's unlimited in terms of capacity, I don't have to rush at all because I know that the money will be there if I need it.
Okay, another thing I want to ask you about bank supervision. It's very complicated, right? And there's a question now about regulation, and if we've got too many regulations, right? And if we need to get rid of some of them. And in fact, Vice Chair for Supervision, Mickey Bowman, has taken this on as one of her projects, right? Um, what do you see most risky right now? I mean, and what do you think about this question of unnecessary bank regulation? Because a lot of people would say, wait a minute, the more you take off the regulation, the more they're going to get in trouble.
So I think, I guess I would reframe the issue is not about not more or less regulation. I think it's about regulations that's most efficient to achieve the desired outcome. So I would hope that what Mickey Bowman has in mind is not reducing regulation, but making the regulation more efficient. So less duplication, less overlap, less complexity. I think you can simplify regulation a lot, and so make the burden on the banks much less, but generate the same outcomes in terms of financial stability, in terms of ensuring financial stability. So I hope that's what she's going for. The second thing that she's talked about is improving the supervisory process itself. She basically has argued that supervision is a lot about process of finding mistakes that banks make in terms of how they do risk management, model validation, in terms of third-party vendor management, all these lots of these operational details. And her point is, let's focus more on how do we make sure that banks are safe? Focus on material risks that affect the risk of a bank becoming insolvent. And I think that also makes complete sense to me. So the question is, how are you actually going to do these things? So the proof of the pudding was how she actually takes the concepts, which
Right.
I think are very valuable and useful, and how you actually implement them in practice. So I think that she's moving in the right direction. I hope it basically doesn't water down the regulation to the degree that it actually increases the risk to the system of in terms of financial stability. But I really do think you can make the regulation simpler and have the same outcome in terms of financial stability. So I'm hoping that's what she goes for. Because
How about
we've seen in the
oh,
last
go ahead.
20 years a lot of problems in terms of financial instability. So
Yeah, we sure have. Well, and also I want a former colleague of yours on the Federal Open Market Committee, Thomas Honig, who then he was the Kansas City Fed Bank president. He went on to become FDIC vice chair. So he has a big foot in financial regulation, supervision, et cetera. And Tom's made the argument for a long time that you don't need as many, perhaps you don't need as many regulations. Maybe you just need to make sure that banks are holding sufficient capital. And that continues. The banks seem to always push back against the capital requirements. People like Tom seem to push for just making sure you got plenty of capital and then you'll be okay.
Well, I think you need enough capital, for sure, but I think that there's also you need to have a credible lender of last resort. That's why I've advocated in a group of 30 paper to require banks to position collateral at the Fed to back all their non-deposit insured liabilities, all their runnable liabilities. I think you need to have, good risk man. I mean, I think so. I think capital liquidity, good risk management, all those things are part of what's needed for to have a safe and sound banking system. Um, but but I would say it's not just capital. I also think earlier intervention of supervisors when things are going wrong. I mean, one of the failures I think for Silicon Valley Bank was it was self-evident what was going on there. They had a huge interest rate maturity mismatch. They had a huge balance sheet hole in terms of the mark-to-market losses. They needed to have a risk officer. They didn't have a risk officer for many months, and they needed to raise capital. And the supervisors could have intervened earlier and more
Hmm.
powerfully there. So I think it's also the supervisors focusing less on process and more on you need to do this so that you're a viable institution.
Okay, and I'd like to kind of encourage everyone to look at the group of 30 papers. And of course, you're on the Bretton Woods Committee. A lot of good work comes out of those organizations you've been a big part of for a long time. Uh, so in terms of, hey, so let's think of research, what you're doing. What's the next big issue or one of the next big issues you're looking at right now, and also with your teams at these organizations?
Well, I'm working on 3 papers right now. That seems like a lot. I'm doing a paper on resolution in terms of how could the resolution process be improved in light of what happened in 2023. So obviously, Silicon Valley Bank didn't have, TLAC capital. It didn't have a way of being easily resolved. The cost of the FDIC was really high relative to the size of the failed institution. In Switzerland, big problems with resolving Credit Suisse. Boy, they basically pushed Credit Suisse into the UBS's arms rather than take Credit Suisse into resolution. So that's one paper. Second paper is about the Genius Act and stablecoins. Basically arguing that the Genius Act is a move in the right direction, but it doesn't really go quite far enough to ensure the singleness of money, that a stable coin always will be redeemable for par. So I'm doing a paper on that. And the third paper that I'm just starting right now is new chair is going to come into the Fed. There's still a lot of unfinished work to do. Powell did revise the monetary policy framework, going back to basically what was in place prior to 2020. But he had promised a whole set of work on communications, and none of that's been forthcoming. And as we talked about before, they need a better framework for QE and QT. So I'm doing a paper, basically, sort of a letter to the new chair about things that you might want to take on at the Fed during your tenure. So
So
yeah,
lots of opportunities,
so
lots of opportunity,
I'm gonna be busy this spring.
lots of opportunities to come back to Central Bank Central.
Yep.
Tell us more about all that. Okay, well, Bill, thank you so very much. Nice to
Thank
see
you.
you,
Yeah,
as
bye-bye.
always. Bill Dudley is former president of the Federal Reserve Bank of New York. I'm Kathleen Hayes, and this is Central Bank Central.